couldn't look past Iress today because it's a hard one to miss, at least judging by the news this morning and the share price reaction. So takeover talks ending between it and EQT after the two failed to come to an agreement, it's believed, on a transaction price, which could have seen EQT buy out Iress. Now, the third attempt was priced at $15.91 a share, valuing Iress at some $3.2 billion, and it came after the company rejected the previous two bids from EQT, saying they didn't provide compelling value to shareholders. So the talks have failed. Iress remaining committed to doubling its net profit after tax by 2025, reaffirming its FY21 forecast for segment profit of between $164 and $168 million. Let's get a view from my guests on what's come to the fore today with Iress. Claude Walker, it's an interesting one, isn't it? Because EQT coming out and saying we've not come across any red flags during our due diligence, but we're not able to sufficiently confirm our investment hypothesis. That's done and dusted, isn't it?
Well, yeah, it is. But there is one bit of new information that we got today that we can say with confidence, which is that Iress looks better from the outside than it does from the inside. So I think that's a negative in terms of the true quality of the business, as well as obviously for the share price. We've seen a bit of a drop today as people who were hoping for the takeover money have failed from the stock.
Where to from here then, Claude?
Well, for me, now of course Rudi is much more knowledgeable about these big old father-in-law companies than I am. But for me, this is a company that is sort of highly valued because of its high resilience and high revenue, consistency of revenue growth. However, from memory, what that hasn't really translated to much impressive profit before tax growth over the years. So I actually think this is a generally overrated company, and part of the reason it's overrated is because it is a reliable dividend payer in, I think, the 3.5% range. So I could definitely imagine, especially people that really love franking credits, I could definitely imagine them buying, holding this kind of stuff. And I guess that's why, that makes sense for those people. But overall, I actually think it's an overrated company generally.
Rudi, your thoughts on Iress, because just reading through some of the broker notes, it appears as if some of the brokers at least don't feel confident that there will be another offer made for the company. But is Iress fine to go it alone and keep doing what it's doing? It's just reaffirmed its guidance as well.
Well, Nadine, let me answer that question in the complete opposite way as you've just heard from Claude. And this is obviously why live television can sometimes be so exciting for the viewers. I own Iress. We've spoken about this in the past. Contrary to what Claude said, I don't think the company is overvalued at all. It's actually undervalued. The reason why Iress hasn't performed share price-wise over the past 5 years is because they felt the need, and probably rightfully so, that they had to crank up their investments. And they're pretty much investing every year now, double the amount that they were investing 6 years ago. And that, of course, has meant that their profit margin has consistently been under pressure over the past 5 years. And that means that even though their revenue were growing every year, their profits were not, and their dividends only slightly so. So if you now hark back to management's forecast, that they're very confident they're going to double their profits over the next few years, then that is probably a call on the margin. And admittedly, investors are rightfully so a little bit skeptical, because they have flagged a couple of times in the past that they believed that their margin would no longer come under pressure, and yet it did the subsequent year again. But of course, margins don't drop eternally, you would expect. So on the expectation that margin starts trending upwards again, that forecast might actually prove quite prescient. And if that forecast is prescient and accurate, then I don't need to do a design here or a special design. The share price will be a lot higher in 5 years' time, or in 4 years' time. It's 21, by 25, it's 4 years. share price will be a lot higher if they do double their profits over that period. I actually can give you a scoop as well, because as I said, I owned the shares, then I get a couple of takeovers, so the share price runs up a whole lot. And then of course it's not binding, and there is no certainty that this will lead to a positive outcome as we've seen this morning, which put me something in quandary, because what do you do? I have decided out of risk management, I sold half of my shares, upon which I have obviously made a very good return in a relatively short time span. And then what do I do with the other half? I decided recently that I would be happy to own the shares if the transaction did not go through. This morning, we have a minus 10%, 11% that goes off the share price. And this is probably the first time on live television that I am not unhappy that share price falls. I might even reconsider that I reinstate the previous weighting I had to this stock. I'll think about it over the weekend. Contrary to what Claude says as well, the buyer of Iress, potential buyer of Iress, obviously was considering spending a lot of money, and somehow they believe that whole image about our customers are relatively sticky, they couldn't make that fit in their own thesis. I'm not so, well, that there is obviously gradations. Usually you get the opposite. Usually the share market doesn't appreciate the stock and then the buyer does. In this case, we get the other way around. They could not get Iress at a cheap valuation, of course. I'm still sticking with management here for the reasons I've just outlined. I'm a happy shareholder. I'll happily cash in those dividends, and I expect them to do well over the next 3 years.
Oh, you've left me in a bit of a quandary, right? So do I call that a buy today, Rudi, for Iress or not?
Oh yes, I would. If you don't own it,
if you're not owning it yet, if you don't own it, today would be a good day to buy Iress.
I would consider buying it. It pays a good dividend, and management is confident that they will double their profits over the next 3 to 4 years. That is something to look forward to.
Claude, were you going to add something there? I will give you an opportunity that you don't have to take it.
I have a feeling that Rudi will do better off with some of his other favorites from Iress. Like, I agree, like, yeah, maybe decent dividend stock, but I just think that if he's, like, I know Rudi's like a long-term style investor, usually going for the long term, and I just think that this company is probably no longer in its prime in terms of it's no longer organically winning more business in the kind of way that maybe it did in the past. And I think that probably to double that profit, they're going to need to buy a lot of, I don't know what they're going to do, but we'll see.
Well, look, we're going to agree to disagree on this one, you guys. And I will put some of those questions to management on Monday. We will speak with Iress CEO just past 11 a.m. Eastern. So yeah, looking to go right to the source.